Welcome back, chumps. I'm the Chump Change Trader, and this is the Small Account Challenge, where I take $2,000 and use massive amounts of pressure to turn it into a diamond. Today is April 16th, 2023. It's a Sunday. This week, I just want to sort of get ahead of the game and sort of walk through a more deliberate kind of strategy for this coming week. In terms of what's going on in the economic calendar, it's actually pretty calm. There's really not much in terms of things that are going to be coming through, with the exception of initial jobless claims and home sales. Those are kind of two other sort of patchwork pieces of information that can help solidify what we already know and paint the broader picture. But for the most part, it's not the economic calendar that really will move markets, in my opinion. It has to do with just sort of the earnings that are coming through. So earnings that are coming through are going to be things like Tesla, Bank of America, some banks, big banks out there, and regional banks. And regional banks have become the major focus of the economy so far, is the result of sort of the the different bailouts that basically had just had happen. So once that sort of comes to fruition and we sort of see on paper just how bad of a economic impact that kind of causes, we'll then see sort of, well, what does the liquidity injection do, and how does that actually affect everything else that's going on. So without further ado, we also kind of want to just sort of think that this week is really just going to be focused on earnings, but simultaneously from a even more macro perspective of what's to come. I have three different types of articles or pieces of information to share. So one of them is actually going to be the Fed Watch tool from the CME Group, and they basically calculated a almost like a consensus poll in terms of what is going to be the current rate hike that's coming up. And so there's an 80% consensus that the next target rate is going to be a 500 to 525 rate hike bump. So that's basically just dispelling the idea that the rate hikes that have been being rate hike pause that the market has been thinking about is pretty much squashed at this point. And so a dose of reality may present itself in the market. Second thing is, that's kind of like a contradictory piece of information, but still good to look at, is CNN Business's Fear and Greed Index. And so they're basically stating that the market currently, is in a state of greed. And that was at the end of Friday. So this doesn't really update, until, I think it does update pretty regularly, even on the weekends too. So that's good. But it hadn't really moved since Friday. So that was that's a good thing to just sort of note. But so you got the market displaying kind of like a sense of greed, where we're kind of reaching and touching sort of like a high for the year, right? Or getting close to it. But simultaneously, the news that I just mentioned is sort of in the fore distance, and it's basically going to be kind of baked in, right? Or at least should be baked in. And then the last thing is that, from a perspective of bankruptcies, this is another new piece of data that has come up, is that we've reached already basically a high, a 12-year high of bankruptcy filings in the first 2 months of this year. So what took 12 years to hit a high of the number of bankruptcies, if you look down in this data right here, it took only 2 months this year to get to that level of bankruptcies. And if it's kind of hard to see, I'll zoom in. I'll accept, because you're really blocking most of my screen right here. So that's pretty telling in terms of where we are from an economic standpoint. Now, the market is not the whole economy, but the market should at least pay attention to what the actual economy is doing. And so far, the market has been kind of turning a blind eye in terms of the actual warning signs that are right in front of us, right? So, will I see, the market doing what it wants to do? I also know that it cannot keep ignoring these kinds of macro signs. And so I'm anticipating in the near future to probably at most the end of the year or towards the end of the year, maybe August is that they get the dose of reality that they've been ignoring for a while, and the market will pull back at some point in time. So keeping that in mind. But of course, I'm not going to want to do a prediction of the market, but rather just sort of mentally prepare and react accordingly once I know that there are some warning signs happening. So what does that all mean in terms of the positions that we have? So we have our 2 iron condors and that 1 vertical put, and the first vertical iron condor and that vertical put is going to expire in 5 days. Since it's Sunday right now, it's literally telling me that in the next 5 days, this will expire. And if you don't know already, options expire, or rather that they get assigned or expire technically on Saturday morning. But because when it hits Friday, you can still technically trade it. It's called a zero, days to expiration, or DTE, zero DTE option. And there's a lot of, craze that's been happening on zero DTE kind of options because of their growth potential and costs, to reward benefits. But simultaneously, you could also lose quite a bit doing that too if you don't know what you're doing. And so let me know if anyone in the comment section below wants to learn more about zero DTEs. That's something I typically want to stray away from, because you can only get paid when you're right in your assumption, and you have to be incredibly right in your assumption of where the market moves in that regard. Whereas in typical 30 to 45 day options with the orthodox strategies that exist, you can get paid when you're right, you can get paid when you're sort of right, and then you can get paid just because time was on your side. So I like having the extra options, literally, of being able to do longer time period strategies, because theta decay or time decay working in my favor ultimately is a helpful tool, even if I'm not directionally correct. So without further ado, we got 5 days left on this particular option right here. It's currently sitting at a profit of $86. I think we were at a higher profit earlier before the market started to move, because we were like smack dab in the middle. And I could have taken the profit there, but I'm greedy because with this large window right here, so as long as the 5 days go by and the market hasn't made a whole new high again of like 440 or above, we will basically take the entire max profit level of this particular option. Granted that this particular option is less than what we originally had, which was about 200 and some change. I think it was like 218, because I had messed up and closed that position. But when I reopened it, it basically will just sort of pick up from where it left behind. And then there's a bit of slippage, or there's a bit of loss in monetary value because of the fact that I had closed a position, opened a new one, and all those decay. Basically the maximum value has decayed from there. So this one won't be the biggest profit taker from that original position, but it is what it is, and I'm sticking to it. Then we have the put vertical right here, which is ironically now more profitable than the original iron condor. It's supposed to help. So as long as I stay within this region and the market doesn't move any further from 418.82, then we should be able to at least profit in some regards. If we make a scratch on this, if I make a break even or a little less than that, I'm okay with that too. But yeah, it all depends on sort of what happens this week. if earnings come out better than expected, which all of the estimates are really, really low. So what they're doing is they're pricing in incredible amounts of downturn on earnings. And if they are not as bad as what people anticipate, then the market can interpret that as a good thing, right? Because it's kind of setting the bar low, really low. And that makes me feel a little weird inside. So that's why I'm just sort of anticipating that I'm going to react in that regard and potentially maybe close a position earlier than expected if for some reason somehow the market gobbles that up and calls that a victory. I don't know. I will be prepared for a situation that could involve that kind of scenario, but it doesn't mean that that's what I think would actually happen. But you always want to be prepared. And then finally, we have our 33-day Iron Condor that's more leaning towards the upside for sure. That will sort of sit here and sit pretty until it decays. Now, it's kind of funny because we've been doing this for several weeks now. And, on these two particular trades, ranging about, I'd say about 400-ish plus dollars, maybe 500-ish, right? If everything goes into line, almost six actually. I've already collected some premium. So let's say $600 worth of positions. We'll take a look and reflect back in terms of the performance of what we're doing on a month-to-month basis. So that way it can reflect as to whether or not that these positions that I'm pushing out on these longer time intervals is really worth that kind of time, like the extended time out. And then maybe I might dial it back to be on a half a month basis or a weekly basis if I'm really feeling cheeky, where we can definitely play big wide ranges at lower premiums and then just watch them decay week after week as the ranges are just way too large for even the premium to catch up with. And that's one way you can go about speeding up the process of being able to capture more premium. But we can always look at that from an analysis standpoint, because I would say that the difference is that the buying power is going to be the same. So if this Iron Condor right here for let's say I did it at 35 days or 45 days, I think it's 45 days out, was like $300-ish of buying power out of the account right here, I think a weekly would cost me roughly the same thing. So let's say if I were to do, I can't really do a weekly, but even if I did a 5 days out Iron Condor of the exact same position size, let's say, what was this? 400, 405, 475, and 480. That's pretty wide. So if we buy the 400, buy the 405, and then, sell the 405, then sell the 470, which is like just $15 at most, and then buy the 475. That's a $25 profit for 5 days, which isn't too bad if you calculate it. That, let's say that's a week, right? And 45 days is approximately 5 weeks. So if 25 times 5, you got $1.25. So realistically speaking, I wouldn't do it obviously for just 5 days. There's too much decay on 5 days on there. But I think the reason why we go about this route is because there's not many, there's actually no weekly options for SOXX on that regard. So I think that's the reason why we've just been sticking with anything that was close to 30 days, 45 days as a result. And then I'm okay with that. Why? Because there's such a wide range in this. This has enough implied volatility that I would like to stick with this. But simultaneously, it also has a lot of breadth that the price doesn't move too much. So it's got the sweet spot of the two opposing, forces that basically contradict each other, hence why an iron condor kind of benefits from this type of movement. We could move to a different equity or a different ETF like the SPY or QQQ and try our luck there. But I just know that like semiconductor spaces have certain kind of responses relative to that, whereas the QQQ or the SPY could move because literally one segment of the entire SPY or the entire Qs would push the whole index forward, whereas semis is only moving because of semiconductors, right? So, if something negatively happens with semiconductors, it may not move the Qs that much, but something has moved the semiconductors, therefore SOXX is going to make a move. So therefore, I will at least be aware of what could possibly make big movements in this one particular sector. But yeah, without making this kind of long-winded and on a tangent, long story short is I'll keep monitoring these two positions, and then as this the iron condor that's 5 days out and the put vertical that's ending soon, as these decay or as these close within the 5 days, then I'll look to, now with those two positions closing, my buying power will then get freed up, and then I'll look to opening another position. And in 5 days time period, with everything that's happening, with the earnings that are happening, and as maybe macroeconomics sort of situation is settling in, I'll probably then figure out whether or not I'll put in a new position that is more directional, or if I feel like, okay, we're still going to keep chopping sideways, I'm going to throw in another iron condor. And I know that sounds boring in terms of like the diversity of positionings, but in terms of trading, you gotta trade with what the market gives you. And if the market's giving you uncertainty, you trade uncertainty. Iron condors benefit from uncertainty. Strangles benefit from uncertainties. And those positions basically gives you a wide breadth to just say, if the market hasn't made up its mind and it's not just constantly moving in one direction, you're gonna benefit from it. And I can't just basically say if what I'm seeing is sideways chop and the best thing to do is to do a position that benefits from sideways chop, to just simply do something else just because of the sake of, showing something different. The main objective of this is mainly to just build up this capital and take advantage of what the market's giving me. And I'm only so far using less than 50% of the buying power that's allotted to me. And of course, that keeps growing as time goes by. And so I'll maybe decide that I'll make a risk here or there, like make a degenerate move just for the sake of it, or maybe for educational purposes. But for the time being, I'm sticking with my guns, and I'm making sure that I'm, looking at what would be the best money maker, breadwinner of this account, while simultaneously waiting for opportunities. Because one of the reasons why you want to leave your buying power also open is that as you have positions open too, you also want to be ready for when an opportunity does come too. So that's like saying, okay, I want to get involved into investing or stocks or options trading or whatever it may be. And then you decide to just go all in with your money on that particular thing, on that particular equity, be it, trading precious metals, crypto, whatever. And then suddenly, another opportunity comes and you are fresh out of cash. And you have no buying power to be able to take advantage of that because you've already just occupied with that, right? The concept of don't put all your eggs in one basket is very much so like an actual reality, both from an investing standpoint and from trading. If you don't, make sure that you are keeping yourself liquid enough and set rules for yourself that you don't stray from that, then you can basically run a gamut of stretching yourself thin, and you have zero options, quite literally, when opportunity comes by. or when you have to defensively make moves. And, this will hopefully be a great kind of reflection of how I react to market forces, especially when things like this are happening. And I'm just like looking as far out as I can see. And I'm just thinking there's a huge disconnect right now. Like, why is it that we have all this negative press, right? That's releasing data, negative press that is built off of data that is negative or not looking good in terms of an economic output. And then simultaneously, we have something like this, where the economy right now, the markets are just basically trying to find and grab hold of anything that they possibly can to just give an excuse to just make a run for it. And I get it. At the end of the day, it's not supposed to be a rational market. It's not supposed to be something that's built off of facts and facts alone. And that's something that you also have to make sure that you understand and that you play into your list of variables as to how you keep track of what, direction that the market could be. So hopefully that this greed index, with everything that's sort of happening, starts to, in the long run, teeter towards the neutral to fear side. And when things get into fear and extreme fear, that's when opportunity comes knocking. Because as Warren Buffett says, be fearful when people are greedy, and then be greedy when people are fearful, right? So, that, as much as I don't want to take everything for a grain, everything, face value that, an individual says, there's lots of virtues from a market standpoint, from an investment standpoint, and from a trading standpoint that Warren Buffett said that's actually pretty on spot. And I wouldn't be here right now if it wasn't for literally that kind of mindset that I have built for myself. So without further ado, if you have any questions, feel free to leave it in the comment section below or reach out to me. And I'll see you all in the next one.